Good afternoon, everyone. Welcome to our SMSF update webinar. We hope you find it informative. My name is Stephen Harvey. I'm the Legal Services Director at Acis, and I'm here to introduce Peter Johnson, who is our SMSF Services Director. Peter has extensive experience in the SMSF space. He's a Chartered Accountant, CPA. He presents on SMSF matters for CPA, teaches super for CPA and Kaplan, and is the chairman of the New South Wales Public Practice Committee for CPA. We're on a fairly tight time frame here, so I'll hand over to Peter without too much further. And if there are any questions, just send them through. We'll either deal with them on the run or deal with it at the end, time permitting. Thank you.
Thanks, Steve, and hello, everybody. I'm certain there is a number of people here that I know very well. Interestingly, we thought we're doing an SMSF update, and it was a year where there were very, very, very few changes in the budget, and we thought the update will take 10 minutes, and then we will have to find things to fill the hour with. However, I ran a recording this morning of the webinar, and it went for slightly longer than an hour. And that's without any questions. So what we're going to do is we're going to make this morning's recording available as a more detailed version of the webinar, as well as this version available, which we'll run through a little bit faster, and will also include questions asked by you guys as we go along. So what we're actually going to be looking at today, I'm going to cover the FASEA changes, which is the education requirements for all financial planners in the country. And so we'll have a look at that, because that also includes accountants coming in next year. We'll then in detail look at the budget changes that affect superannuation, not just SMSFs. The tax office have just mentioned a few things in conferences over the last 12 months that they see as issues. There's also issues that we see at Acis that we believe we need to raise with accountants, just to let them know where things are going wrong and where you might come up with problems in the future. We will have a specific look at transfer balance caps and what to do with the reporting on transfer balance caps. And we will close with questions. But of course, if you have questions in the meantime, just post them on the question board there, and Stephen will regulate those and come and tell me which ones I need to talk about. So first of all, FASEA changes. So it's the Financial Advisors Standards and Education Authority. So from the 1st of January next year, we know that the whole education requirement to be a financial planner will change. Now, this includes an accountant who's going to be a financial planner or wants to be one as well. It also includes an accountant who just wants to be a limited license holder or a limited authorised representative. Now, obviously we have existing advisors and there'll be new advisors. There's existing advisors with qualifications, and there's existing advisors with related qualifications, and existing advisors without the necessary qualifications. So we'll run through all of them. So the majority of you will be people with an accounting degree. If you're listening to this and you have a financial planning degree, that's a bit different, but the majority of you will be people with an accounting degree. So if we look at existing advisors with an accounting degree, now accounting degree extends to banking, finance, economics and law. They're all called related degrees. And so what, if you are an existing advisor as at the 31st of December 2018, then over the next 5 years, we must complete 3 additional transitional subjects to stay as a financial planner or as an authorised rep. Now, the first of those 3 subjects, and yes, here we go again, everybody, we have to do ethics again. So the first subject is one, or it doesn't have to be done in this order, but the one subject is ethics. The second subject is a subject on consumer behaviour, and the final subject is a subject on the corporations law requirements of financial planning. So they're the 3 subjects that you need to do, and these subjects are at graduate diploma level. So they actually need to be provided by an education provider and approved and everything like that. Now, all of these subjects need to be completed before the 1st of January 2024. So you have 5 years to do these 3 subjects. For existing advisors, so you'll need to be on the Financial Advisors Register on the 31st of December. You then have 5 years. Now, there are some advisors out there who don't have a related degree. Now, that could mean that they're existing advisors who, and there are many financial planners who all they have is a diploma of financial planning. It's not a degree, it's not higher than a degree. They may be accountants who don't have a degree, they have a diploma in accounting, or they may not even have the diploma, and they may have done the old Chartered Accountants program before there were degrees. So if you're one of these advisors, so you're an existing advisor as at the 31st of December this year, then you will need to obtain a financial planning degree or higher, so that's graduate diploma or a master's. Now, obviously, of those 3, the shortest one to do is the graduate diploma. It's 8 subjects. A master's at New South Wales Uni, I know, is 16 subjects, and a degree could be 24 subjects, although you may get some exemptions if you have another degree. But you'll need to obtain one of these qualifications in order to continue to be a financial planner. And you need to do that before the 1st of January 2024. And I've certainly got some advisors myself that don't have the degree. They've been chartered accountants for many, 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 many years. And thankfully, because they've been chartered accountants for many, many years, they're saying they're just going to pull the pin before 1 January 2024. And I know that there are a lot of financial planners who are in that boat, looking at getting out by 1 January 24. So that's existing advisors. New advisors from the 1st of January 2019. Now, who this applies to is anybody that is listening in that is thinking, next year I'm going to become licensed to give SMSF advice, or next year I'm going to move into the financial planning space. So this is what you're going to be required to have in order to become an authorised representative of a financial planning business. You will need that financial planning degree or higher. So if you have a accounting degree, that doesn't work. So you would need to then go and get the graduate diploma in financial planning, and that will then qualify you to be able to become an authorised rep. You can get the master's, but you must get it before you can actually be appointed. Now, unfortunately, there's another kicker that goes with that. On top of getting the qualification, you also need to do a professional year. And we don't exactly know yet what that will entail. But if we look at doing the professional year as a CPA or CA, it means you need to work under or be mentored by a CA, CPA. And I would imagine that this will be a similar requirement, but it could be as bad as you need to go and be employed under another authorised rep for a period of 12 months, which would almost make it impossible for a self-employed accountant to become a financial planner after the 1st of January next year. So it really means that you need to consider what you're going to do before the end of this year, because you can become qualified this year because you only need to get that diploma subject, and then you can be authorised, and then you've got 5 years to do the transition. But come 1 January next year, it's at least 3 years before you would actually be able to become an authorised rep. Now, on top of all those things that we talked about, everyone has to do a competency exam. So everybody that wishes to be a financial advisor from 1 January next year. For existing advisors, we have until the 1st of January 2021 to do the competency exam. New advisors need to do it before they are actually authorised. I don't think this exam will be overly difficult. They're talking about it being 75 questions, 70 of which will be multiple choice, and 5 of which will be short answer questions. So I don't think it's a major issue there. Okay, so moving from there onto the FASEA changes, and we've just got a question about emailing the slides. Yes, Irina, they will all be emailed out, plus there'll be recordings. So the budget changes, and as you know, there's not too many budget changes this year. The first one, and the one that's certainly having the by far the biggest impact on the profession is moving to a 3-year audit cycle. And I know that this came as a massive surprise to everybody, that no one saw this coming. And there's been a lot of fight back from the profession about that. And so now Treasury has released a discussion paper, but just about under the current proposal, who is entitled to move to the 3-year audit program. And initially, what they say is there must be no breaches in the fund, so no audit contravention report for 3 years. And as we say, this starts on the 1st of July next year. So no breaches for 3 years. All lodgements need to be on time for 3 years. So you could inadvertently cause your client to not be able to move to the 3-year audit cycle if you lodge their returns late. So you need to be mindful of that. And that's at this stage what it is. And Treasury have released a discussion paper. There is a link to the discussion paper, and they're asking for submissions on this discussion paper before the 31st of August 2018. And I was having a talk to an auditor the other day because I was referred some advice where a client had only in the last few days moved into a holiday house owned by their SMSF that they intend to buy off the SMSF. So it's really a retirement house, it's not a holiday house. So they've moved into this retirement house on or about the 10th of July, and they're now paying rent to their super fund, and they thought that was okay. And what we now know is that that retirement house is a in-house asset, but it wasn't an in-house asset on the 30th of June. So there's no breach as at the 30th of June. There is a breach now, but the in-house asset test isn't as at the 18th of July, it's as at the 30th of June next year. If they're still in that house as at the 30th of June next year, and they're paying arm's length rent, so it's all a commercial arrangement, then the only issue the fund's got from a compliance point of view is that it's breached the 5% in-house assets provision, and the trustees must put in place a written plan as to how they're going to sell that asset over the next 12 months. And if they do sell that asset over the next 12 months, there is no breach of the SIS Act at all in that fund. So these guys have got 2 years to get their affairs in order, to sell their house in Sydney, get the cash, give that cash to the super fund, buy the property off the super fund, and there will be no breach. But they know about the breach. Their auditor knows about it, but you could see how a fund could inadvertently breach the in-house asset provisions and not find out about that for 3 years, and then it's too late for them to put the written plan in place. So we really do need submissions to go in, and we'll have a look at where the government has addressed things like this in what it's talking about for the 3-year plan.
The question there, Peter, is will the auditor audit 3 years or 1 year out of every 3 years?
Okay, so we've got a question there. Will the auditor audit, is it a 3-year audit or 1 year every 3 years? The answer is that it's a 3-year audit. So if you've got a client that from 2019 is on the 3-year cycle, so we've got 2020, 21, 22. So at the end of the 2022 tax year, you'll be required to audit 3 years worth of that fund. So there's no reduction in the amount of auditing you've got to do, but what it means is you're auditing it in 3 years' time. So this is why I say these problems may not be found for 3 years, and it could create major issues for these clients. And so that needs to go into the submission that you lodge. Now, we talked about, I've lost the thing. We've talked about the discussion paper. So the tax office have actually. Yes, we've got a question if this will be recorded. Yes, this is recorded, plus there's an earlier one we did today that will be recorded as well. The discussion paper talks about the events where, at this point in time, the tax office are thinking this would now trigger an audit on an annual basis. So what they're saying is, first of all, the commencement of a superannuation income stream by a member for the first time. So start a pension, that triggers an audit that year. So straight away, but it's the first time. If you commute back and start another one, then that doesn't matter. It's the first time you commence a pension that would trigger an audit. Interestingly, we like this one. The death of a member will trigger an audit. So I find that very interesting. You've died, so you get audited. I don't know how they're going to punish you, but anyway, they're going to audit you after you die. If you add or remove a member, you will again, that's the trigger for an annual audit. So obviously, even if you're not an auditor, you know all this stuff because the auditor won't know that one of these events has happened. So it's up to the accountant then to say to their client, by the way, we're now on an annual audit. If you receive non-arm's length income, but once again, the accountant may not know that it's non-arm's length income. That may be the auditor that needs to audit it to determine whether or not it's non-arm's length income. So you may not know you've actually received it, but it's a trigger for an annual audit. Commencement or maintenance, and this is the big word there, maintenance of an LRBA. So every fund that has an LRBA will be audited on an annual basis. I don't know why they see them as a higher risk of compliance, but for some reason they do.
Peter, question. Can a practitioner opt not to move to a 3-year audit program for their clients?
Okay, it's a good question. The practitioner doesn't make that decision. It's the trustees of the fund. And absolutely, the trustee can elect to not be audited every 3 years. And in talking to auditors, what I'm hearing often is that they're saying, I've still got to do the same amount of work, but I'm doing it every 3 years. And a lot of the work I'm doing is auditing stuff that's 3 years old, which means it'll be a lot more difficult to get the information. So Pete, whilst my audits are $440 a year, I would anticipate that the fee for a 3-year audit may be something like $1,650. So in actual fact, it'll be 30% dearer overall to audit every 3 years than every year. And when we look at the discussion questions that the tax office are asking, we will see that that's one of the questions they're asking, so that we need submissions to go in about that. Another one is an acquisition of an asset from a related party. That will trigger an annual audit, as will investments, loans or leases with a related party. That will also trigger an audit. So in the case that the example that I gave, where the people moved into their property on the 8th of July on an arm's length basis, that would trigger an annual audit anyway. So you would hope that at the end of that year, the auditor would pick up and go, right, we need the written plan. You've actually got to buy this property off the fund before the end of the year.
Apparently some people are having sound problems.
Okay, some of you are having sound problems. Okay, it might be my microphone, so I'll look at that a bit better. Can we just have the next slide, please? Yeah. Any in-specie lump sum payments to a member. So it doesn't include cash payments to the member. It only includes lump sum payments to the member. Okay, now the discussion paper has given some key questions for us to consider when we are making submissions. How will fees change? And as I've said, the submission should be along the lines of, we're still doing the same amount of work, we're lumping it all in together, and it will be 3 years old, which means we believe that there will be more work to do. There'll be more than 3 times the amount of work to do 3 years worth of audits, because you've still got to check each year. Your permanent file is still only once regardless. You've still got to check that off each year. So they want to know, how will fees change? They've asked, would we consider, or do we suggest an alternate definition of a clear audit report? Now, what I think that is suggesting is something along the lines of, you may have put in a management letter to a client saying that you want them to address something in the next financial year, but you haven't breached them, but you're okay that they fix it next year. Well, that may then need to be reported that, well, I'm now requiring an audit next year as well because of management letter issues. So that needs to be put in on the submission. What is the most appropriate definition of timely submission of the superannuation and SMSF annual return? And again, what if it's not the client's fault that they're late? What if it's the accountant's fault that they're late? So should it be that, provided the accountants complied with their lodgement deadlines, that we're okay? Again, we need to put this in a submission. The key events, I think they got the key events pretty well okay, but you might think of something that is a bit different, that could be another key event that would trigger, and it could just simply be, a key event could be that an auditor has not breached the fund, but has found something in the in the fund that would require an annual audit and would require them to audit again next year, and which events present the most significant compliance risks, and you could put down anything you want there. I think most of those are also covered in the discussion paper with the trigger events. Should arrangements be put in place to manage the transition? And I think, of course, staggering is extremely important. We can't say to every auditor in the country, you'll be working hard next year for the 30 June 19, but then you'll take 2 years off. You'll have to, put 3/4 of your staff on leave for 2 years, and then the following year you'll have to employ all of those plus 2 times as many for another 12-month period. That's just impractical and unfair. And any other issues that you think are important for that. Okay, so that's 3-year audits. Interesting. And I really don't know that it will see the light of day, but the government seem hell-bent on it, hence the Treasury discussion paper. Go and have a read. The next change in the budget that you'd all be aware of is expanding the SMSF member limit from 4 to 6. And that's pretty simple, sounds very simple, no problem whatsoever. Let's just now allow 6 members. But as Stephen pointed out to me, there is a section in the Trustee Act of Queensland that limits the number of trustees of a trust to 4. And that section goes on to say that where there are more than 4 trustees named on the deed, then only the first 4 are trustees. So if you set up an SMSF with 6 individual trustees, all 6 execute the deed, you've breached section 17A because you've only got 4 out of 6 as trustees, notwithstanding what your deed says. So all the auditors in the room, you can run amok with that and have a lot of fun. I'm pretty sure that none of the accountants listening to this would go and recommend individual trustees for a 6-member fund. But there's a lot of clients that go and do their own stuff and they set it up themselves and they go online and, they're asked, do you want a corporate trustee or individuals? What's the difference? The cost? They go, I'll take the cheaper version, please. Victoria also has a limit of 4 trustees, but that's only naming it on title for a property. So in those cases, you would need a declaration of trust to say that it's held for the benefit of the fund. Life insurance changes now for superannuation. It's not just SMSFs, it's superannuation. It's now going to be opt-in for members under 25, and this is a really good idea because there are so many young kids out there with 3 or 4 funds, and they're all getting their balances eroded by unnecessary life insurance. And 3 or 4 years later, they've got no money. And we all understand the impact of compound interest. If you've got 20 grand when you're 25 compared to 13 grand when you're 25, that's going to have a massive impact on their retirement incomes. And so it really is important to do that. Further than just members under 25, balances under $6,000 will also be opt-in. So if you've got a small balance in a fund, they won't be taking life insurance out and won't be eroding your fund down to 0 over the next few years. Now, there's another one, life insurance contributions. If you haven't contributed to the fund for 13 months, then life insurance automatically ceases. They can no longer take life insurance unless you opt in to take it. Now, where we need to be really careful here is lots of us in this room have said to our clients, we'll set you up with an SMSF, but we'll leave, pick a number, $20,000 in your existing fund, and you'll continue to pay your life insurance premiums out of that existing fund. Now, this new law, if it gets through, means that 13 months later, your life insurance benefits will cease unless you opt in. So we know what clients are like. They tend to forget things. There's going to be a lot of people out there that are going to inadvertently lose their life insurance benefits. We need to be really careful and make sure that you stress that in writing to all of your clients. Now, the work test exemption. This is a new one that came in, and I really don't know how much it will be used, but there is a work test exemption for persons aged between 65 and 74. So they won't need to meet the work test in order to contribute, to make a contribution to super, whether that be concessional or non-concessional, where they have a total superannuation balance of under $300,000. So they get that 12-month exemption and they can certainly make contributions, and that cuts in on the 1st of July 2019. Now, of course, I often say to people over the age of 65 that normally have a combined total superannuation balance of under 500,000 that you probably don't need money in super anyway, because you won't be paying any tax outside of super. You won't be paying any tax inside of super, but you will be paying fees. So you really need to model what's happening with clients that are in this position. And of course, not many of these clients are taking advice from an accountant, because once they're 65, they're not doing tax returns. And so they may not be turning up anyway. Okay, so this is for your surgeons that are working for 3 hospitals. So let's say you've got a surgeon, he's getting 200 grand a year from one hospital, 200 grand a year from another hospital, and 200 grand a year from a third hospital. So he's getting $600,000 a year in salary. So he's going to be putting $50,000 a year as SGC contributions to super, which is in excess. So he'll have a contribution problem there, although all of the employers must pay that money because he's under the contribution cap limit. So what they've brought out is that an employee can go to the tax office where they're in this position, and it's likely that they'll exceed their concessional cap, and they can apply for a certificate that they can then give to their employer after the 1st of July this year, and say to their employer, you're exempted from paying SGC for me. Now, I'd assume that they'll go, but you've got to pay me the salary instead, and they can negotiate. The employer can negotiate. The employer is not obliged to comply with the certificate. They might say, no, it's too hard. We just don't have the ability to not pay you the 9.5% or whatever. But where they can come to an agreement, the employee can get the certificate from the tax office and give it to the employer. It only covers a single quarter. So you basically need to do it every quarter. There are ways of getting multiple quarters when you apply, but you need to give them a certificate each quarter. Could also have trouble where they're paying monthly and things like that. So that's the employer shortfall exemption certificate. Okay, now, as you know, we're able to make, as of this tax return, like this from 1 July 17, people can get a tax deduction for personal contributions. Now, this could be anybody. Anyone that's completing an I return can now get a tax deduction if they've got employment income. So there's a lot of people moving into this area for the first time, and the government have contributed some money to checking this area, making sure that people are lodging their 291.70 notice of intent to the super fund and are getting an acknowledgement from the super fund. And they've actually now put that into the I return. If you're claiming a tax deduction for super contributions, they're asking that you have received a confirmation from the employer, from the super fund. So that's now in the I returns. Okay, superannuation guarantee amnesty. This was another surprise from the government, that they're now actually allowing companies that have not met their SG requirement to make a contribution and to get a tax deduction for it. Now, the kicker here is that it's not law yet. A certain number of people have actually already made their contributions, but it's not law yet. It hasn't gone through the Senate. And worse than that, it applies from 24 May 18 to 23 May 19. Now, obviously, some people wanted a tax deduction for the super, so they wanted to make the contributions last year. So they've actually gone and fessed up that they didn't meet their SG requirements in previous quarters, and now they've fessed it up, but the law's not there. So if the law doesn't go through, we're not yet sure how the tax office is going to treat those confessions, I guess you would say. So it actually covers every quarter up until 31 March 18, because it was announced in May. So obviously you had an opportunity to pay your June quarter on time, but every quarter of SGC since SGC came in on 1 July 1992. So it covers all the quarters, so you can pay everything back for a long time. You are still liable for the SG shortfall. In other words, you're still going to pay the super guarantee. You're still liable for the nominal interest and general interest charge, and that was fair because the clients haven't had the use of the money for a long time. you can either pay this money to the tax office or to the fund. If you pay it to the fund, you can pay the interest to the fund and not to the tax office. So your employees will actually get the interest. And you won't be liable for the $20 per quarter per member administrative component, nor will you be liable for the penalty, the Part 7 penalty. And the really good part of it is that you actually get a tax deduction for the full amount, the SG shortfall, the interest, and the GIC. So there's probably a lot of clients that will want to take advantage of this. And so, yeah, wait for it to become legislation. Now that the financial year's finished, you may as well wait and have a look at what's happening. Also, there is no doubt an issue if someone's paying 10 years worth of contributions, you could very easily go over the caps. So the Commissioner can disregard these catch-up payments for concessional cap purposes. We just have a question.
Sorry, Peter. The question is, I was under the understanding that the GTIC was waived also as part of the amnesty.
Okay, I was reading this from a document. I could be wrong there. So check the GIC. I was reading a tax banter paper that Robin Jacobson presented to my group recently. It would make sense that the GIC is also exempted, but just check that. Thanks, Greg. Now, not only can the Commissioner, I'll just get the next slide up, disregard them for concessional cap purposes, but the contributions won't count towards Div 293 income. Now, what, again, I didn't ascertain out of that was, will the contributions be subject to Div 293 tax? It won't count towards your income when they add super contributions, but I'm not certain as to whether or not it will count towards the tax, so whether or not you'll be paying 30% on them.
Peter, another question, can we or can the client request an exemption from a contributions cap under the amnesty?
Yeah, well, I guess they would have to. So what will happen is automatically they will be over the cap, and then they would need to write to the Commissioner and state that this was a SG amnesty payment, and it says that the Commissioner can disregard it, and I reckon that they would disregard it. I would also think, though, that if there's someone that is, you know, got that much, that they'd probably know about their employer's failure to pay super. I think mainly people that are, unless there's some really derelict employers out there, I'd like to know that I'd like to think that the employees know about this already. Hairdressers, I know that certainly my daughter's worked for hairdressers, and when you talk about super, they go, oh, well, no one pays that. So, but I don't know there'll be many of them going in over the 25 grand. Okay, so that's the SG amnesty. Now, other issues that the tax office have talked about and we have seen over the last 12 months. The first one we all know about, just requires a reminder. Can you click, please, mate? Oh, sorry. Yeah. A reminder is that the preservation age is now 57. Now, there's a little bit of a funny part to this, and what I often say is, how many people who turn 57 this year will have turned 56 last year? And the simple answer of that is 100% of them. So what that means is that nobody will reach preservation age this year because they all reached it last year. So just remember that when you're dealing with people that, just click on, yeah, that's 57. Now we'll look at TBARs and pension reporting. I know there's still accountants getting this wrong because I was talking to some guys the other day and they hadn't lodged their first TBARs as at the 1st of July because they said the members had less than $1 million balance. But you do need to lodge that any pensions that were as at 30 June 17 that went over to 1 July 18, so a pension that continued, needed to be reported as at by the 1st of July. Now, going forward, so from 1st of July 17, so a pension that commenced on the 1st of July 17 or later, you actually, and this is where the $1 million cap comes in, if the member's balance is $1 million or more or over $1 million, it says, then you need to report a TBAR on a quarterly basis. So that's only where they're over $1 million. If they don't have $1 million, then I'll do it again, mate. Then if they don't have $1 million, then you can report it on their annual return. So it's either quarterly or annual return. And here is a link to the TBAR instructions, and I'd suggest that if you're dealing with them, just take a little bit of time to read these. Now, the first quarterly report, even though a pension that commenced on 1 July 17 for a member with over $1 million had to be reported quarterly, and you would then think, oops, I should have done it at the end of September last year. The first quarterly report is due on the 28th of October this year. So you've actually got time to do all your quarterly ones.
Question here, Peter. Where there's a member with a transition to retirement income stream and they turn 65 in January, say, this year, the member balance is less than $1 million, is a TBAR report due on the annual return?
Okay, good question. And the answer to that is yes. So one of the things that a TBAR, where the member turns 65, is a new retirement phase income stream, because the Tax Act was amended to say that if you're on a TRIS, when you meet a condition of release, you go from pre-retirement phase to retirement phase, and you're now a new retirement phase income stream. And under the TRIS rules, when you meet a condition of release, if that condition of release is age 65, then it's an automatic movement to retirement phase. So, yep, if it was under $1 million in January, then you need to report that as movement from an accumulation benefit effectively to a retirement phase income stream, and but it can be reported with the annual return because their balance is under $1 million. Now, if you're in a TRIS and you meet a condition of release other than age 65, so changing employment when you're over 60, turning 57 or 56 last year, or becoming totally and permanently disabled, then that's an automatic movement to retirement phase after you notify the super fund that you've met that condition of release. There's no need to commute the pension back, and so it's automatic. You're actually in retirement phase. So, yep, that's a good question, and we will cover it a bit as well when we go forward. Can I have the thing back, please, mate? Now, you also have to report some LRBA payments, and we'll cover the LRBA payments on their own, because the government said, LRBA payments are used to support pensions. So we'll cover what needs to be reported as effectively a new income stream commutation. Like, if the commissioner sends you a note that says you are over your transfer balance cap, please commute $300,000 back from this fund to accumulation, and you do it, then you need to notify that on a TBAR, which is fairly logical, really. Now, if you receive a structured settlement, let's say you're 48 years old and you are in a motor vehicle accident and you are given $5 million in compensation because you've been made a quadriplegic, and you put that $5 million into super, that's a structured settlement contribution, and that structured settlement contribution is a debit on your transfer balance account, which means that you can now put another $6.6 million into pension phase. Now, I've only dealt with 2 of these, and in both instances, we put the contribution into super. It's a non-concessional contribution when it goes in. There is no cap on the amount you can put in. You immediately commence a pension. That pension, therefore, is 100% tax-free. And if it's only the amount that you contributed, it won't have an impact on your transfer balance account, because the structured settlement went in $5 million. The next day, or the same day, we commence a pension with $5 million. It's a debit and a credit of $5 million, so your balance is still nil for your transfer balance account. Question?
Question, is the $1 million total of all pension and accumulation accounts in the fund for that member, or is the TRIS section of the fund that is the $1 million that the $1 million relates to?
Okay, so that is a good question. You can't have more than one accumulation interest in a fund, but you can have more than one pension interest, and you would argue that it would have to be the amount of that interest being $1 million, because we may not know and be looking at other ones at the same time. You would know the position your clients are in, and as such, you could use that as an excuse to talk about it later. And I guess what we're getting to here is that we want a pension to commence on the 28th of June, and we don't want to meet the minimum pension payment requirement. And they had, and so then we don't want to have to report the commencement of that pension until we do the return in May, and then we want to make the minimum pension payment early June. So, yeah, I guess it would be that if you've got two TRISs, they're separate superannuation interests, and as such, it would account to that interest. I will confirm that, and when we send the slides out, just to make sure that it is a separate interest, and as such, it's only each interest that gets looked at. Any commutation needs to be, and you all know this. So, you know, if as soon as you commute back, you get a debit onto your report. Now, LRBA payments, and this one is fairly complicated, and I still can't 100% get my own head around it. But where an LRBA payment increases the value of a member's interest, and I don't know that it necessarily does that because you're converting an asset being cash to reducing a liability being a loan. So it shouldn't really have an impact. But where it does it, then you need to report that LRBA payment as a pension commutation. So what does it mean? First of all, it's got only an LRBA commenced after 1 July 17. So that's a lot fewer, thankfully. And where it's sourced from assets not in retirement phase. So this can only be an issue where your fund is part pension, part accumulation, and therefore you're making payments out of a part accumulation, part pension to an LRBA, where the LRBA relates to members in retirement phase. So they're the ones you'll need to report. So I would certainly be suggesting, where you can, that if you have an LRBA with a member in pension phase, that you separate the pension fund from the accumulation fund, so you don't need to report the LRBA payments. Where you've got two members, so mum and dad are in a fund, both in pension phase, and you are reporting, then you need to apportion the amount between the members on a fair and reasonable basis. So I guess you just use their opening balances and apportion the payments in accordance with what their opening balances were. So that's what we report on a TBAR. So what don't we report on a TBAR? And the first one is pension payments. You don't report pension payments. So what does this say to us? We've got a $1.6 million pension, and the guy's taking a pension and he wants 120 grand a year to live on from his $1.6 million pension. We can do $120,000 worth of pension payments, $10,000 a month, and there's nothing to report. His 1.6 balance will stay at 1.6. No matter what happens to the fund, he's at 1.6. Alternatively, he could say, I only want the minimum pension, which is $80,000 a year, and assuming he's 65, but in June, I'm short of a bit of money, so I'm going to write to the fund, request that they commute 40,000 back to accumulation, and then immediately pay that out to me as a lump sum. So whilst, remember, we reported back any commutations, but we don't report pension payments. So by doing the 40 grand lump sum, the client then reports that 40 grand as a debit on their transfer balance account, and therefore they'll be able to commute more money back to pension phase later on if for some reason they need to. So really what it's coming down to now, it's going to be very rare to advise somebody to take anything other than the minimum pension, so and take everything else as you can as lump sums. You don't have to report investment earnings or losses, which is really good, because if you start a pension with 1.6 million and you own a property, 2 years later they rezone the property, you sell that property for a $3 million gain, that does not impact on the client's transfer balance account, which means we really need to look at clients that have got accumulation and pension interests. We need to look at separating those interests into separate funds so that we can keep the good assets with really good growth potential in the pension and the other assets in accumulation. And I know with the number of people in the room, there's a lot of you thinking, hang on, that's a scheme. And The tax office have discussed this, and they've certainly talked about situations where it is a scheme, and they've talked about situations where it isn't. If you're thinking of doing that, please talk to us so that we can run through your client scenario to make sure that it would be acceptable to the tax office. Okay. Now, what not to report when an income stream ceases? Obviously, that's logical because there's nothing left to report. There is no income stream. You don't need to report on the death of a member. I guess the tax office worked that out themselves. And any information that individuals report directly, which is family law payment splits, fraud, dishonesty, bankruptcy, structured settlements, made before 2007, which is when the new rules came in. Okay, quick TBAR example. Peter turns 65. He's got 2 trisses, one of 1.3, one of 600K. He gets the minimum pension from each monthly. So we've got to report the 1.3 and the 600 separately. The TBAR balance, I'm not sure if that's available through the tax agent portal, but I'm pretty sure that it is. The minimum pensions received, so there's no reporting the pension. He rolls back, he gets some advice, he rolls back 340 on the 1st of August. We need to now notify that on a TBAR. So he's got a month of being in excess of his cap, so he'll receive a notice from the tax office to pay a little bit of tax. He's 300 grand over for 1 month. They'll assess that as earning 10% interest and charge 15% tax on that amount. He then takes another lump sum that's reported. He's well below. He then dies on 1 October. No need to report that. So all of those was 3 July 18. So the $1 million one needs to be reported quarterly. The $600,000 one doesn't need to be reported quarterly. The rollbacks, because it was the big account, 340 on August, would need to be reported quarterly because that was $1 million balance at the time. But the second one would be able to be reported as at on his annual return. But we would suggest in this case where he was over that you get the reports in as quickly as possible to save the excess. Now, reversionary pensions versus death benefit pensions. There's too many accountants that think you can only pay a pension to a dependent where it was a reversionary pension from the member being in pension when he died. That's not the case. Now, what I'll refer you to initially is Law Companion Ruling 2017-3. I'll just talk about being the LCR. I'll also refer you to Regulation 6.21 of the SIS regs that says that a pension can be paid, that any death benefit can be paid as a pension to a death benefit recipient. It's also in the LCR. And a death benefit recipient is a spouse, a child under 18, a child 18 to 25 in full-time education, or a child that's disabled. If I die today, my wife can receive a pension, notwithstanding I'm under 60, notwithstanding I'm under 55, and notwithstanding she's under 55. We can still pay her a pension. Any death benefit can be paid out as a pension. Now, with a reversionary pension, your transfer balance credit occurs 12 months after death. And with a non-reversionary pension, it arises on the start date of the new pension. So I've got some examples just to take you through this. And remember that a death benefit pension can't be commuted back. It must be taken as a lump sum. Okay, so reversionary pension example. And this is the one from the LCR. Theodore starts a pension on 1 October 17. Doesn't matter the amount. The rules of the fund say that it can revert to a dependent, and he nominates his spouse as his dependent. He dies on the 1st of January 2018. His wife, Valerie, is his reversionary pensioner, which means that on the 1st of January 2018, that pension is now Valerie's superannuation interest. There's nothing for Theodore to leave in a binding death benefit nomination. It's now Valerie's pension. Now, let's say that pension at the time was $1 million. That was the value of the pension on 1/1/18. That now means that on 1/1/19, there's a transfer balance credit of $1 million to Valerie's account. Now, if Valerie's already got $1 million pension, then she actually now has an opportunity, you'd probably do this in late December 18, to commute $1 million back. Well, actually, she's still got a $600,000 balance on a transfer balance account, so she would have to commute back $400,000 to have $1 million credit. So she could actually run with that just before time. That's the beauty of the reversionary pension. You've got that year. But now we'll look at an account-based pension where Nathaniel starts an account-based pension on the 1st of October, and he's not setting it up as a reversionary pension, just an account-based pension. There's no nomination. We'll assume that his wife's the other trustee and he doesn't care what she does with the money. It's her money anyway. She's in control. Again, he dies on the 1st of January 2018. At the time of his death, his balance has gone down to 1.3 million. Okay, so we're now down to 1.3. Melina is Nathaniel's wife, the only beneficiary and the other trustee. But regardless, she's got control as to where it gets sent to. From 1/1/18, it goes back to accumulation phase. We understand that the pension ceases. And Melina decides to deal with it on the 15th of June 2018, and she decides to take the whole lot as a pension. Now, but between 1/1/18 and 15/6/18, the value of the pension goes up because we're not taking any money out of the pension. So it now goes up to $1,305,000. That's the balance as at 15/6. So now the death benefit commences, the death benefit pension commences on the 15th of June, and the transfer balance account amount is $1,305,000. Now, of course, we still have the opportunity from the 1st of the 1st to the 15th of the 6th to commute back any of Melina's existing pensions. And we even have the opportunity to commute back her pensions after, but we can't commute back the pension commenced with her husband's because it's a death benefit pension and that can't be commuted back. So we have plenty of time to play with fixing things up with pensions that are commuted. Talk about that. Now, one of the issues that we're finding at Acis is with related party loans, and there's still too many mistakes being made by accountants. So I just wanted to cover what the rules are with related party loans, and I'll refer you to PCG 2016-5. And if you don't know this, and you have any clients that are ever going to deal with related party loans, read this and understand it. What are the requirements for the safe harbour provisions to know that your related party loan won't be deemed to be non-arm's length income? First thing is you need a written loan agreement. That's easy. You can come to us and get a written loan agreement with no problems. You must use the RBA interest rate, and yes, we put that into the loan agreement that you'll be using the RBA interest rate, but as the accountant, you need to make sure you account for it using the RBA interest rate, which at the moment sits at 5.8%. You must register the mortgage, must be registered, and these can be searched. So remember, don't get an audit done by an auditor at the end of the year and they do a title search and there's no mortgage registered. This could lead your client to having non-arm's length income, and that includes any capital gain made on the sale of that property, even if they're in pension phase. Now, the PCG says that payments are made at least monthly. There's no provision in the PCG to say that you can pay in advance. It says they are made at least monthly. So there's nothing that says you can make one payment at the start of the year. So again, I would suggest that you tell your clients to set up an auto direct debit from day one to make sure they meet payments at least monthly. It also says a 15-year term. So again, that's in your loan agreement. But when you're doing the calculations for the client and working out how much they've got to pay, make sure that you calculate it out over 15 years.
Peter, just sorry to interrupt. The minimum payments under the PCG have to be P&I. So you've just got to be careful that your calculation of the monthly payment on your direct debit stacks up to that P&I.
And does P&I, good. Yeah, well done. That's good. Okay, now what shouldn't you be doing? What are the things that we get sent to us on a weekly basis that we then go back to the accountant and go, no, do not do this? We've actually had questions regularly. Do I need a bare trust if I'm borrowing off a related party? Absolutely you do. The law doesn't change in that regard. This one here is a bit of a kicker, really. If I've got an LRBA and I've got a company as the trustee of my super fund, and I lend the money to my super fund to buy a property, but because I'm a cheapskate, I don't like to buy companies, I don't like to spend money, so I want to be the bare trustee as well. So I become the bare trustee. Now, if I'm the bare trustee, my name's on title. I can't register a mortgage in my own name. You can't grant yourself a mortgage. So it's not actually possible to register a mortgage. Now, I would think, yes, that probably would still be deemed to be a commercial arrangement. But the problem you've got there is with the tax office, and you then need to deal with the tax office. So that becomes a bit of an issue there. Clients want to match the lower bank interest rate. Oh, but I've got to charge 5.8. St George only want 5.3. I say to them, that's fine. I now disclaim any responsibility for the tax office auditing this as being non-arm's length income, because this is your opinion, not mine. And I also suggest that you provide personal guarantees, because St George also require personal guarantees, and you have all the other provisions of a St George loan.
Yeah, that's quite true, Peter. I think the comment needs to be made in relation to the PCG and the safe harbour rules that it brought in, is that you don't have to use the safe harbour if you don't want to, but you have to be able to prove that the arrangement is commercial. So you're going to have that argument with the ATO, whereas if you do tick all the boxes for the safe harbour, you're not. And the time and expense in dealing with establishing a commercial arrangement to the ATO's satisfaction is not something your clients really want to go through.
Yeah, exactly. Now, the other one I get occasionally, and we were doing this a lot before the tax office released its thing about non-arm's length income, was borrowing to buy units in a related unit trust so that that unit trust can do things you can't do under an LRBA. I've submitted a private binding ruling application around this, and the tax office came back saying, no, it will be non-arm's length income because you haven't demonstrated that there is a commercial lender who will do this for your client. And we had found one, but they wanted about 13% interest, and the client wasn't willing to pay 13% interest to himself, which basically defeats the purpose of doing this whole thing in super. So be very, very careful about doing LRBAs for units in a unit trust, because I think you may need to have to charge a lot of interest. Now, lending for the deposit, and along with that, lending for the GST, just won't cut it. The accountant says to me, Pete, lots of people will lend to my clients on an unsecured basis. Why can't I just do this on a commercial basis, being an unsecured loan? And I come back with, yes, but they won't lend on a unsecured basis, on a limited recourse basis, because their liability is limited to the asset you're buying, and they won't actually have security over that asset. They won't have any security. There'll be zero recourse to this loan. So therefore, I don't believe that this loan would be arm's length. And then the final thing, if you're going and buying your documents off an automated provider, I see too many accountants do this as well. They have a company as the lender. They lend to the super fund. They totally forget about DIB 7A, thinking we don't need to comply with DIB 7A. You do need to comply with DIB 7A. You need to comply with both 67A, the PCG, and DIB 7A. So, you've got to make sure you meet the minimum requirements of both of those. And yes, of course, we have a separate DIB 7A loan to a normal LRBA loan. And when you submit your loan application and we see a corporate lender, we will ring you to go, does this need to be DIB 7A? Sometimes it's trustee of a family trust, and it doesn't need to be. So we're right at the end of our time. We have 2 minutes remaining. So are there any questions, Steve, that people have got that we...
Just backing up a little in relation, there's one in relation to related party LRBAs here that's just come in. When recalculating monthly repayments with a new interest rate, do we use the original loan amount or do you use the outstanding balance?
Yeah, that's a question where it's pretty difficult for accountants, because banks have fantastic software. What you need to do when you use a new interest rate is you actually need to go back to the original loan amount and calculate the minimum payment based on the original loan amount. And when you allocate that to a higher interest rate on the new balance, you'll actually find it still works out to be exactly 15 years, because you're going to make slightly higher repayments, but you're also going to be charging slightly higher interest, being the exact same amount. So what you do is you go back to the original loan amount, go rightio, using a loan calculator, 15 years, say it was $1 million, 15 years, we did it at 5.75%. The minimum payment was this. Now we go back 5.8% on $1 million. The minimum repayment is this. Now, notwithstanding you now only owe 500,000, you still have a higher minimum repayment. Now, you can, of course, refinance if you want to make the repayments less. So you can do what banks do, like I've paid a heap off my home loan. I still have a massive minimum repayment because I'm in advance. If I want to reduce that repayment, I've got to refinance the home loan. You can do the same thing if your clients are way in front and they wish to reduce the amount that they're paying on a minimum basis.
I think we're going to have to call it quits there, Pete. Thanks for all your questions. I know that we didn't get to all of them, but we will try and field those after the webinar. If you do want to send further queries through, please feel free to do that. You can send them to acis@acis.net.au or to legalservices@acis.net.au. You'll also see our 1-800 phone number on the screen in front of you, so you can give us a call. Feel free, and we look forward to doing this again. Cheers.